Good afternoon. This is Travis Bement with YourOrlandoMortgage.com. Hope everyone had a great 4th of July weekend. This is my economic commentary for the week of July 6, 2009. Have we fixed housing? As the government continues to roll out new measures to help avoid foreclosures, I thought now would be a good time to assess how these programs are working. Let's start with some basic facts. No matter what anyone thinks of the current rules or any new programs, some families are truly being helped to stay in their home. Additionally, I don't view these measures along any party lines. Chances are, no matter who is in charge in Washington, many of these programs would exist simply in reaction to the current housing crisis. Last week, Fannie Mae and Freddie Mac announced that starting September 1st, they would begin to accept rate and term refinances of certain Fannie and Freddie loans, up to 125% of current market value. A customer could refinance up to $125,000 on a property currently valid at just $100,000. Customer would also be allowed, with lender approval, to keep any second mortgage in second mortgage position with no cap on the loan to value. Currently, the maximum loan to value in this program is 105%. To remind you, all of these programs came from the Help Avoid Foreclosure initiatives started by the White House earlier this year. There are many problems at 105% or 125% with these programs. The main one is that these programs exclude many of the people that need the help the most. Many customers have loans currently owned by Fannie Mae and Freddie Mac that do not qualify for the program. These loans could have been bulk purchases or have stipulations in place that do not allow for this kind of refinancing. Many of them, however, are loans that were purchased by Fannie and Freddie that were either subprime or stated income or reduced documentation. These loans had looser underwriting guidelines and usually carried higher rates. Assume for the moment that the loan was subprime or that the customer previously did not provide income documentation. If they're able to qualify under today's tighter standards and provide full documentation of income and assets, why not allow these loans to be redone as well? I would bet that these people are, on average, more affected than the typical borrower. The other issue, the government feels that simply just because they created programs, investors will buy into that program. The problem with the current Making Homeownership Affordable program is that investors will not purchase loans without additional price increases. In most cases, a customer who owes between 95 and 105% of the current value on their home and has a rate of about 6.5 currently would see absolutely no payment savings on a refinance loan. In many cases, their payments would go up. Obviously, that does not solve the problem. I will take flag for saying this, but the programs to help homeowners should be designed with people with mortgage experience. I know some of the same people that got us into the trouble are these people with mortgage experience, but they may be the only ones to get us out. Thanks, and I'll see you next week.